In today's In Conversation With session, we're going to take a little bit of a side turn from our normal conversations with our CIO, Damian Barry, where we always get his insights into what's happening in markets and portfolios and so forth, and delve a little deeper into a really important topic around investor behavior and portfolio construction, and how these two things are inextricably intertwined, both to help people keep from doing their worst behaviors and ultimately help grow their wealth in a more stable way. Damian, in all of our conversations, we're usually trying to do several things. We're trying to explain what's happening in the world. We're trying to give some context and framing for that. We're trying to help our clients understand what that means for their portfolios, and try to do a little bit of education, a little bit of explaining. But given the conversation that a lot of clients are having about, what should I be doing, and this doesn't feel right, and so forth, it feels like a good opportunity to delve into two things really specifically. Just a bit of a reminder about how we approach investing and why, so sort of a bit more of a process refresh, if you will, and how that syncs up with investor behavior, right? And when some of the challenges we know that all of us have as human animals, and the need for and the role for a disciplined process. I mean, just having a process doesn't make it a good process. So it's not enough to say you have to have one and stick with it. It has to sort of be structured and thoughtful. And let's talk through that a little bit, and hopefully that'll help remind some people in the current environment what we're doing and why, and how it helps them not succumb to some of those emotional pitfalls.
I think it all sort of, the behavioral aspect, it feeds into our investment approach in a key way.
Clearly.
It really underlies the reason why there are these long-term drivers of markets like valuation, profitability, why these things exist. It's because we are behavioral, because we are emotional. And that's what causes this opportunity for us to find value in markets.
Let's start with that, actually, and I think probably the most obvious example is value, and the tilt we have to value, and a little bit about why value works as a tilt, as a theme, and that relates to some degree around investor behavior.
Yeah, and I think a lot of that is because we all like to be in the herd. We like to buy stocks that people are talking about that are going up, and often for success in investing, you have to do what's uncomfortable.
Mm-hmm.
So maybe it's the unloved areas of the marketplace, the overlooked, and if you look at people like Howard Marks, that's what he said. It's not finding the stocks that people like. It's finding the stocks that are underestimated.
Yes.
And this is really what drives a lot of our processes. How do we find those pieces of the market that are underestimated?
Now, I think a client, if they were trying to do this on their own, or say an investor, would look at some of these and say, well, these investments are down because there's a problem. Why would I want to own this thing, right? It's obvious and completely rational that I don't want to own this thing, and the market's telling you so by moving the price down.
Right. And I think investors need to ask, what's the reason for the price being down? Is it fundamentally driven, or is it sentiment? Is it because of news headlines? So often we see the baby getting thrown out with the bathwater, right? When markets go down, and actually, having a disciplined investment process is making sure that you find companies that actually have positive fundamentals, where the earnings are improving and they're not too richly priced. And these are the kind of qualities that keep your portfolio performing well over the long term, is by not falling into those traps of saying that by reading too much into the price action.
Right.
What you need to do is look at the fundamentals, and that's different to just the price action.
Picking up on that, one of the examples I often give people when I get into this conversation is that somehow in investing in money, the brain works differently. Right. So if you have had your eye on this particular piece of clothing at your favorite shop for a while, online or in real life, and you keep popping in and taking a look at it and saying, oh, I really want to get this, and then suddenly it goes on a 30% sale, Your reaction isn't, oh my God, there must be some problem with it. Your reaction is, this is phenomenal. I can finally get it. And the reason for that is that there hasn't been a fundamental change to the thing. It's just cheaper, which is exactly your point about the fundamentals in price and the relationship between them.
And don't you think psychology is such a big part of investing?
Huge.
I mean, and I've seen surveys where they ask people, if they think they're better than the average investor. And 75% of people think they're better than the average investor.
It's like classic Lake Wobegon stuff.
Right. And people, there are different personalities. And sometimes men are worse at this than women, is being too confident in their own prediction.
Yeah.
And if you think that doesn't apply to you, then maybe you are overconfident.
Maybe you're the one.
Exactly. So these are the behavioral aspects that we need to think about, and they are the reasons. They are the sort of building blocks of our approaches. Understanding this is what drives markets is human nature, and we all know the right things to do, but we just don't always do it. We don't do the wisest things. We do the easiest things, and for instance, like now you don't have to go on a diet, but. We all know the right things to eat, but we still go for the burger and chips or burger and fries, right?
Yes. Yeah.
Now, why do we do it? We know that it's not good for us. And similarly in investing, people do things that are not good for their portfolio. They speculate on things that are just not healthy in the long term.
I like that analogy because there's so much that really tracks across, right? So in the short term, when you buy that stock that's been going up and everyone's talking about, there really is that positive bump of, hey, I get it, and I'm in the in crowd, and it may go up for a little while longer, and you feel that sort of positive reaffirmation and so forth, even though in the long term you're probably increasing the courting of disaster in doing that. And it's very much like your food analogy. And that in the short term, it feels great and it tastes amazing and so forth. And it seems positively reinforcing that you did this the behavior that deep down you shouldn't, but it feels like it was a good idea. And you don't immediately see the negative effects. So there's a real parallel there, actually.
I think it's that sort of helps explain to people just that there are the right things to do and the things that people do, and it's trying to help people, guide them. But at the end of the day, we know that markets will be ruled by emotions, and that's why we build a strategy that takes advantage of that. And I don't know when this video goes out, but the markets are still influenced by humans and not AI. And as long as that's the case, you need to have an investment approach that takes advantage of the frailties of human nature.
Well, we'll have to have another session where we do a really deep dive in AI. I know I've been to a lot of these conferences lately, but of course, even that is ultimately learning based on humans. So it's incorporating a lot of the same biases and foibles that it's observing, which is from us anyway. So that may not be the reprieve to this, even when we get there. So if we are trying to incorporate what we know, and I use that word cautiously because it's hard to say what you really know, but there's been decades of research around this field, this behavioral finance field, trying to understand the emotions and the pitfalls that human animals fall into when they're trying to engage with money and investing. So it's not new and it's not unique to us. There's a lot of information out there.
Huge. And people are welcome to search on AI, under behavioral economics, on the psychology of markets. There's people like Professor Taylor, who's written about this, who got the Nobel Prize for his understanding of the behavioral aspects in economics, not just markets, in economics.
Yeah. Given that there is so much research in this space, given that we have built processes to try and incorporate that, I think it's also important to acknowledge that in the absence of those processes, investment process, rebalancing process, how you weight portfolios, that in the absence of that, we fall victim to these things too, right? Which is not that we are trying to set ourselves out as somehow smarter than the average bear. But the point is that you have an investment philosophy and an approach to investing that sets up guardrails to prevent those impulses from leading to worse outcomes.
Right, exactly. And because of having an investment approach that is disciplined, that doesn't try and say, we know better than the market, because we are humble about that. We can't predict the market. And those that do have had their challenges, as we've seen recently. And I think it's about building a plan for the long term and understanding that we don't know what's going to happen, but we want to have an approach that's going to rebalance and take advantage when there are bouts of volatility, because we know that will happen.
Yeah. So this has been hopefully a helpful reminder and a little bit of a deep dive, but let's wrap this a little bit with a reminder of what we're actually doing. So let's try and make this, a practical explanation. So without having to go into too much crazy detail, let's talk about portfolio construction and what are the elements that we have in how we build portfolios that try to either offset or take advantage of these issues we've been talking about.
Okay, so let's talk about buying a business, the simplest sort of form of investing. What are the kind of things that would be important to you if you're buying in a business?
Price is always there.
Price is an important aspect. And another aspect might be profitability. How profitable is the business?
For sure. Yeah.
And really, we're saying actually we want to incorporate those two drivers because they are drivers of outperformance. And we're incorporating them by looking across the market and saying we want companies that take into account the value of the company relative to its profitability. So we're taking in both those aspects. And over time, we expect that will lead to outperformance.
So the problem is that sounds so logical. Isn't everybody doing that?
They are doing it in different forms. Some people are trying to do it by picking the companies themselves.
Okay.
What we're doing is doing it in a more systematic way, rather than going through each company. And the amounts of information that are available today is just enormous. Yeah. Can you imagine trying to analyze Apple and trying to get an information edge, on that company?
All right.
And not to mind all the other thousands of companies that are out there. What we're looking for is characteristics that lead to outperformance over the long term. And it's not just what we think, right? There are lots of research that we can point clients to. There are famous people in science, in academic worlds, people like Fama. These are people who've won Nobel Prizes for what they've been teaching us. And we apply these principles in our portfolios of looking at things like valuation and saying, the price of something should be important. Don't just buy the most expensive stocks. That might work some of the time. It may not work all the time, right? And these are prudent things to do in a portfolio, is to look at the price of something relative to its profitability.
Absolutely.
And sometimes we go through periods in history where markets get ahead of themselves, where they get excited about a new technology and they go, this is going to change everything. It could be pharmaceutical companies with weight loss drugs. It could be AI. It could be something else. And they get infatuated with it.
Right.
And these stocks go up and then they come down again. And what we want to do is try and give clients a more stable ride where they don't have that sort of that roller coaster ride. By looking at and staying out of trouble, not buying into companies at the peak, and then having to go the roller coaster and head down with those companies. And a lot of that is understanding the behavioral aspects, sticking to your process, and that should be a winning formula.
That's part of where the human foible kicks in so much, right? So unfortunately, we are driven by stories. What we really love is stories. So while your explanation of what one ought to do in terms of understand the relationship between price and profitability and so forth, I don't think anyone would hear that and say, that's a terrible idea. And I think people would listen to that and say, that's what I'm going to do. But what they actually do is they hear a story and they love this story about how I sat down across the table from the CEO. I had this great vision going to Mars, or there's this cool new drug or whatever it is. And that they like the story of what could happen much more than the analysis of, well, what's actually in reach now and what kind of growth rate needs to happen for that story to turn into a valuation that makes sense. And that disconnect between a prudent, thoughtful, rational, evidence-based approach and what we crave as humans, which is, tell me the story and let me get excited.
Right.
And then that's how you get to that irrationality you were talking about, that exuberance.
That's exactly right. And I think this behavioral trap that people often fall into is confusing companies with stocks.
That's a great point.
And it's very easy to say, I love this company, I love their products, I'm going to buy the stock.
Yeah.
Now, that's not a rational way to approach investing. You've got to look at the price of that stock, relative to its earning ability.
Right.
And sometimes that might be really inflated. So these are things that you need to take into account to stay away from the traps of just falling in love with your portfolio. And it's the biggest temptation we often find with clients is they want to buy whatever is working.
Yes.
This theme seems to be working.
Right.
And I don't know over my career how many themes there have been, but it must run into thousands, right?
Yeah.
There are a couple of themes that stand the test of time, over 100 years of time. And those are things like valuation. Those are things like profitability. Yeah. And we want to be in those themes, not to be buying the latest fad or fashion.
Which is hard to explain sometimes because people will look you in the eye and say, well, what are you, some kind of idiot? Don't you see that AI is taking over the world, or robotics, or there's a global aging of population happening? These themes are obvious, and clearly you should be positioning to take advantage of them because everyone knows they're happening. And that confusion between these big macro trends and what that means in terms of actual investable opportunities, and the fact that that's actually not that obvious in terms of who benefits and how and when and at what point and at what price and what's already priced in. And when you get into the actual details of it, while the big global trends might seem, fairly well understood, how to actually think you can successfully invest those themes with some specificity, that's not the same thing.
It's not the same thing. And that's why we have an approach that looks at things, that looks right into the detail. It lifts the bonnet on this and gets right into the engine and say, what's going on in the marketplace? And let's not get too caught up in the latest fad or fashions because we've seen them all before, and I'm not just saying that AI is necessarily a fad, for instance. I mean, it is undoubtedly changing the world. Mm-hmm. Is it going to be the largest companies in America that are going to benefit? To some extent, but I suspect the beneficiaries will be quite widespread, often smaller companies. And I think you're going to see small companies do quite well. They're going to be able to apply the efficiencies that AI brings us. Mm-hmm. And that's going to have a broader effect. And trying to pick the winners and losers is going to be such a minefield. You need to have a systematic approach that looks at overall what are the different things that are happening in companies, what's the cash flow like, what's the earnings ability, what's the value of the company. It's not just about playing because you've read it on some social media website and because it's gone up a lot. That's the worst possible reason to buy anything.
Yeah, exactly. This has been really helpful as a reminder and, a bit of a deeper dive into what we do and why and how that's meant to both protect people from themselves and take advantage of how that gets reflected in market movements and valuations over time. And I think it's important to recognize that, there are opportunities that we are seeking to capture, that your portfolio process is capturing for the benefit of clients by being patient and long-term and rational and evidence-based. So thank you for that.
Thank you.